we interrupt regular coverage with a developing story that demands your full attention. Financial markets are abuzz tonight with news of a leaked update involving the Vietnamese Dong and contract exchange rates that signal a seismic shift in the currency landscape. The details are emerging right now, and we are bringing you the first comprehensive briefing on what could be a major game-changer for businesses, investors, and policy watchers alike. In a highly unusual and sensitive leak, draft contract rates pegging the Dong against the US dollar and other major currencies have surfaced. These proposed new rates suggest a recalibration so significant, it could have far-reaching effects on remittances, importers, exporters, multinational firms, and the broader Southeast Asia regional currency dynamics. This is unfolding as we speak, and we are parsing every nuance, charting the potential trajectories, and assessing the ripple effects that may follow. We begin with what has just come to light. Draft contract rates, internal figures not meant for public distribution, have been exposed. These documents detail proposed changes to the Dong's peg, with potential adjustments ranging from subtle repricing to broader reevaluation of the policy corridor. The leak reportedly originates from within a circle of trading desks and financial institutions that handle fixed-rate contracts for key clients. The immediacy and sensitivity of the leak cannot be overstated. These rates, were they to be enacted, would affect fundamental pricing structures and forward contracts in the FX market. Market participants are already reacting, with exchanges showing heightened volatility in Dong-related forward points and deliverable currency pairs. The mere suggestion, now beyond the corridor of confidentiality, has injected a tremor of pricing uncertainty across the board. The leaked information suggests that authorities are considering a shift that could alter the Dong's trajectory, or more precisely, its valuation. The nature of the proposed change could be interpreted as a re-anchoring to a new midpoint or corridor within which the currency would trade. This has immediate relevance to the forward and spot markets. Contract rates quoted in these leaked drafts propose adjustments that would raise the Dong's value modestly against the US dollar, though the full scale of the change remains unclear. Initial reactions from market insiders indicate a willingness to reposition portfolios, hedging strategies, and risk exposures. Banks are moving swiftly to recalibrate their internal pricing models, and corporate treasurers are reevaluating their hedging coverages and procurement schedules. While these are draft contract rates, the leak alone has prompted immediate speculation about whether official policy is shifting. For any state-regulated currency like the Dong, even the perception of adjustment can spur realignment among traders and institutions anticipating policy signals. The story has taken on a heightened sense of urgency. Financial media, trading rooms, and emerging market analysts are scanning the implications. A subtle revaluation could benefit import-reliant firms by lowering Dong-denominated costs of foreign goods. At the same time, exporters could face margin pressure if the Dong appreciates. Banks managing US dollar liquidity against Dong may need to hedge more aggressively, and offshore Viet-denominated positions may see a premium or discount shift. Adding to the intensity of this development is the timing and context. Vietnam's recent monetary policy and growing macroeconomic stature, including trade volumes, FDI inflows, and inflation targets, all intersect with any currency move. A re-benchmarking of the Dong may be intended to signal confidence, to ease import costs amid rising global commodity prices, or to recalibrate inflation anchoring. Conversely, it could signal a response to foreign exchange pressures or a shift in capital flow strategy. Whatever the rationale, the leak has amplified anticipation that an official announcement could follow swiftly, and markets are already primed to interpret signals, tone, and verbiage from any central bank communication. On the ground, foreign exchange desks in Hanoi and Ho Chi Minh City are triangulating between the official daily fixing rate, the interbank market, and forward swaps. While the Dong remains tightly managed, traders report growing activity in structured products and swaps that could hedge against both postponement and swift enactment. Some market participants cite significantly thinner liquidity, as counterparties hesitate until clarity emerges. Others report heightened inquiries about forward contract pricing for later months, signaling that corporates are positioning for a potential revaluation window. Traders note a willingness to adjust margin and credit terms as volatility edges up, though no one wants to be caught flat-footed if the shift is announced abruptly. In international markets, Funds and institutional players with exposure to EM Asia currencies are monitoring closely. Analysts specializing in Southeast Asia are recalculating scenario models. Portfolios with currency overlay strategies now face recalibration. Should they hedge more dong, less dong, or to what degree? The scenario planning diverges dramatically depending on whether the adjustment is minor or substantial. A modest rebenchmarking may result in a temporary repricing wave followed by stabilization. A larger shift could introduce sustained volatility, potentially echoing through regional peers as investors reassess ASEAN-focused EM exposures. Corporate importers of raw materials or intermediate goods denominated in US dollars are among the first to pay attention. A stronger dong would reduce their cost base and improve margins instantly. Exporters, especially those pricing in foreign currency, could face squeezed profitability unless they raise prices. Cross-border supply chains spanning Southeast Asia may see ripple effects. Sourcing decisions, contract renegotiations, and pricing strategies may be reworked in real time. Buyers and sellers are requesting updated quotations, some seeking forward index-linked terms to insulate themselves from further swings. Financial institutions in charge of remittance flows are likewise on alert. Inward remittances converted to dong may yield slightly more if the unit is revalued modestly. Remittance corridors, particularly to rural areas, may benefit. But conversely, outbound remittances from Vietnam could become more expensive. Money transfer operators are monitoring exchange rate tables closely, ready to adjust pricing and margins, even though formal approval or policy statement is still pending. One cannot ignore the macroeconomic implications. Any re-anchor in the Vietnam Dong reflects a balancing act between inflation control, growth management, and currency competitiveness. Policymakers may be seizing an opportunity or responding to market signals to nudge the currency without explicit acknowledgement. The leaked contractual rates may have been part of internal scenario testing or stress simulations. Yet once leaked, they spill into market psychology. That alone can generate real impact. Market watchers note that even before formal release, parallel market fixings, onshore swap rates, and interbank bids have begun to drift toward the leaked levels. As we continue following this story, there are questions emerging about credibility, intent, and timing. Will authorities confirm or deny the leak? Will the leaked rates be enacted as presented, modified, or abandoned entirely? And crucially, when? Market participants caution that policy may remain tight-lipped until the last moment. Then spring change with minimal preamble, a playbook seen in other emerging markets in recent times. That approach minimizes speculative build-up but amplifies immediate recalibration pressure. Alternatively, a full press release with accompanying policy explanation could accompany implementation, giving markets time to breathe. Whatever unfolds, clarity will be critical for stabilized adjustment. Analysts are also watching the inflation outlook. A stronger dong can clip import price inflation, easing pressure on consumers, but may hurt price competitiveness. Sectoral winners and losers could quickly emerge. Fuel importers, technology assemblers, manufacturers reliant on imported components could all recalibrate their financial forecasts. Domestic demand may shift accordingly. Consumer prices might moderate, even if temporarily, giving breathing space to the central bank. Conversely, exporters might push for wage moderation to preserve margins. Industries such as textiles, electronics, and agriculture that are export-oriented may push back or adjust strategy. International traders, including sovereign wealth funds and global GSEC investors with regional mandates, are also weighing capital flow implications. A revalued dong could signal openness and confidence, attracting portfolio inflows. At the same time, it might damp outbound investment if anticipated returns decline. Balance sheets denominated in US dollars may see changes in loan-to-value ratios, prompting rebalancing. That, in turn, may influence bond yields and funding costs. Meanwhile, we are monitoring responses from currency swap facilities, FX lines with offshore banks, and development finance institutions. Any change to the dong's valuation could shift reference points for existing facilities. Some may need repricing, others may trigger covenant flags. Risk managers are scrutinizing clauses tied to exchange rate performance, looking for repricing triggers or margin calls. In short, what began as a leak in contract rates has blown open into a full-blown currency drama. The markets have taken it as a credible signal that could herald a strategic adjustment. For those with exposure to Vietnam, this is time-sensitive, high stakes. For importers, exporters, traders, remittance agents, investors, policymakers, and regional market watchers, the clock is ticking. In the next moments, we expect official channels to issue statements or deliberately hold silence. Financial watchers will dissect any communications for tone, timing, and implication. Did the central bank issue any guidance? Did the Ministry of Finance weigh in? Was there a digital press release or social media post? In some corners,